UTX is one of those where it should really be in more of the defensive growth camp, and it was trading like it was a beaten down cyclical, and quite frankly, with the 6% free cash flow yield going higher, actually, remains that way. So what we like about it is, with the visibility of this portfolio and the long cycle nature of the businesses and kind of this inflection in free cash flow, this is one where, given the bounce in some of these more beaten down cyclicals, you can actually buy visibility and growth at a really cheap multiple, and you don't have to worry about this kind of prevailing sentiment trade, which can change with each ISM print.
It's interesting. Josh was making the point a few moments ago that you can wait for the breakout if it floats your boat, but it's coming, and maybe you're suggesting as well that you can get ahead of this rather than wait for it because there's this compelling enough story to do that.
Yeah, and there's not that many stocks out there. The visible growth stocks are expensive, and now actually, when you look at these cyclicals and the moves they've had, a cyclical name like Rockwell in my group is already trading at 20 times earnings, 14 times EBITDA. These cyclicals are now, quite frankly, expensive. So this is, in my view, one of the best of both world stocks. And again, what I think long-onlys should like about it, and people who are looking longer term, is that this really is much more about kind of a 5 to 6 year investment cycle now coming to fruition. And when you get these long cycle investment cycles right, these turns can take many years, almost decades, to play out, and that's really where we think this company is, especially with their geared turbofan on the aviation, on the aerospace side.
Hey, Steve, do you think UTX specifically, and then other names in the industrial space in general, benefit from money coming out of Boeing and GE and companies like that? Like, are there other areas that you would look at as candidates for a rotation within these sectors?
Yeah, so our favorite pair has been over the last, since we reinitiated on UTX this spring, was long UTX and short GE. Because when I look at these two engine businesses, again, GE has really cleaned up over the last several decades based on their dominance of the narrow body market. They now own close to 65% of departures globally. In our view, that's a market share that can do nothing but really go down from here. And we believe the UTX geared turbofan technology is ultimately a better technology, and that they are the share gainer over the next, call it, 1 to 2 decades. And by the way, very minimal exposure to the MAX with these guys, really only in their UTAS business. That's a sole sourced GE engine. So, on several fronts, we think this aviation business at UTX is better positioned than GE's, and you're getting it for a 6 and change % free cash flow yield versus GE on our numbers is trading obviously a lot more expensive than that. So I think this is one company that can certainly benefit from any money that comes out of those guys, and then obviously Honeywell is another we've liked for a long time. That's a little different story. Plenty of capital to deployed, a bit more on their front foot as a defensive growth stock, and a little bit more expensive, but still the balance sheet differentiates there. And when they deploy their capital, I think that's the next kind of catalyst for that guy.